and we're going to jump right into the material. So the first thing that I want to talk about today was one that everyone kind of asked for. They asked for questions on this, and this was finance, okay? And specifically talking about mortgages, okay? So finance and talking about mortgages and how mortgages work, and people ask a couple questions. Here are like the hot button questions that people were asking, okay? And I'm going to write them up here. What is a point? Okay. Who is the mortgagor? Mortgagee? Okay. What is the difference between FHA and VA loans? Okay. And here's what I'm going to ask you. So, was there anything that you think I'm missing from that list? PITI? Sure. What is the difference between? Oh yeah, LTV is the top one. LTV. What is LTV? What is PMI? Okay. What is PITI? Okay. And I actually have some people on here that could probably answer some of these ones. Oh, Freddie Mac, Fannie Mae, and Ginnie Mae. Okay. Yeah. So we're talking that is the secondary and primary market. So, and what I'm doing here is this. Okay, debits and credits. Yeah. So we'll talk a little bit about debits and credits, maybe. Okay. Secondary and primary market. Okay. Yeah, those are good ones. So what I'm going to do is this. We're going to talk about a lot of these different things, and I see bridge loan was in there too. Okay, fantastic. We'll talk about what a bridge loan is. So yeah, so someone's asking what that bridge loan is. And what I'll do is I'll get into voidable when we get into contracts, because I think that contracts will be the next topic that we go over. So I think we have a lot of stuff that we could start with. So what I want to do is I want to start with, getting into a lot of these different things, okay? And I see someone said also balloon payments. Yeah, we'll talk about like those different kinds of things while we're talking about, mortgages and whatchamacallit, and the different type of financing instruments. So, Jaretta wrote in, so I think also another one that we're going to have to talk about is maybe the difference between deed of trust, and that's it. So I want to get into it now because we got a lot of stuff that we could go through on there, okay? We could probably spend the whole time going over this stuff if we wanted to, but like I said, I want to talk on other things too. So let's talk about what a mortgage is. So who can tell me what a mortgage is? What is a mortgage, okay? What is a mortgage? When I say mortgage, what is that? So let me tell you my definition, okay? Let me tell you my definition. So, Clara wrote in a great answer, okay? So she said a pledge for debt. Well, you said pledge of debt, but let me actually, that was the closest one that I saw in here. So let me actually go into this, what a mortgage is, okay? So a mortgage is pledging your home as collateral for repayment of a loan, okay? So here's what happens in the actual transaction. You ready? So here's the big bank, okay? Here's the bank, okay? And they have money right there, okay? So the bank has all that money, and here is little borrower, okay? And the little borrower says, hey, bank, I want that money, okay? So what they do is this, the bank gives the borrower the money, okay? So the bank gives them, let's say $100,000 to go and buy their home, okay? So they give them $100,000 to go and buy that loan. And this little borrower is super happy, okay? Because they got that money and now they could go buy that little house over here and they're going to be super happy with that. Now, the bank, listen to what I'm going to tell you. The bank's not going to sit there and just give out the $100,000 and say, oh yeah, I'm so glad that you're happy. Like, great, fantastic. No. The bank's like this. Wait a second. We just gave you $100,000. we need a couple things, okay? We need a couple things. So the borrower goes, okay, what do you need? And he said, well, we would like to have a promissory note, also known as a note. So let's just put note there, okay? And what a note is, so who can tell me their definition of what a note is? Angela, you are 100% right, but I'm going to get to that, okay? And Clara, that is probably my favorite definition of what a note is. It's an IOU, okay? It's an IOU. So it's basically saying, hey, I promise to pay you back, okay? But listen to this. The note is not that good by itself, because do you ever have that friend that tells you, oh, I'll pay you back? And you're thinking in the back of your head, please, you're never going to pay me back. I'm never going to see that money. Like, you have that one friend, that one relative, that one sibling that you know their promise to repay you is as good as you could throw it. And so let me get a thumbs up or a big preach, Stu. Yeah, you know that you have that one thing, okay? That you have that one person that you're like, no, we don't trust you. So think about this. The bank feels the same way about you. Okay, so when you just come in off the streets and you're like, I have $100,000, you're like, wait a second, I don't know you from anywhere. I get that you're giving me an IOU, but like the bank's like, that's not good enough. Because what if you just stop paying me? Okay, so the bank also requires in a mortgage transaction for the borrower to give the bank a mortgage. Okay, so here's what a mortgage is. A mortgage is basically the pledge of real property as repayment for the loan. So you're using that as collateral. Think of like Monopoly, right? Think of Monopoly. You mortgage the property, then you get the money. So a lot of people think this. A lot of people think the money is the mortgage, right? A lot of people say, oh, you're going to get a mortgage, because that's a slang that we kind of use. And that's what we use in real estate too. So I'd be like, so how are you doing so far, Mr. Buyer, as far as getting your mortgage? Okay, they're actually not getting a mortgage. They're getting a loan, right? Like, so realistically, I should be saying to them, hey, how is your loan process going? But no one says that, because they just kind of be like, oh, you mean my mortgage? And you'd be like, yeah, how's your mortgage process going? So what happens is this. The mortgage is something that the borrower gives to the bank. So if we know the EE-OR rule, okay, EE receives, OR gives. The mortgagor, who's the mortgagor? I think one of you said it already in the chat. Who's the mortgagor? The buyer, the borrower. The borrower gives the mortgage. The borrower gives the mortgage to the bank. Okay, so the borrower, this little happy fellow right over here, is giving the bank the pledge of the real property. Okay, they're giving the bank the mortgage, or the one who gives the mortgage is going to be the borrower. Okay, so they give it to the bank. The bank is the mortgage E. The borrower is the mortgage or. Okay, does that make sense? Give me a thumbs up if you're like, oh, I get it now. Because the money's not the mortgage. The money is not the mortgage. The money is not the mortgage. Okay, so what happens is this. The bank is going to end up getting a mortgage and a note. So they have an IOU, okay, which, like I said, that's like they take that as like the same as an IOU from your cousin Bob, who's like you're like, oh yeah, no, I'm not going to see that money back. And then what happens is, to secure it, they also take a mortgage, which is that pledge of real property. And now the pledge of real property, the mortgage, allows the bank to place a voluntary specific lien on that home. So the bank puts a voluntary specific lien on that home. Okay, so that is the instrument that allows them to do that. So the mortgage is the pledge of real property. So what we've identified just now is who is the mortgagor and who is the mortgagee. So we got a couple things down already. So now let's talk about the primary market and the secondary market, because I think that that's just a natural progression with the drawings that I have up here. So here's the thing. Let's think about this. Let's think about your favorite department store, okay? My wife's favorite department store, she misses going there, is a little place called Macy's, okay? She loves herself some Macy's, okay? So here's what happens. My wife goes to Macy's and buys all the things at Macy's, all the things. She buys the Coach bags, the jewelry. So let's say Macy's has no more stuffs in it. Macy's has no more stuff, but they're left with all of my wife's money. Or and probably all of my money. Okay, so what happens is this. So Macy's now, let's say the Macy's in Freehold, New Jersey has no more stuff in it because my wife went on a shopping spree. Okay, now what happens is this. Macy's goes to Coach, they go to DKNY, they go to all the manufacturers, and they say, hey, we have all this excess money. Okay, could you give us more stuff at wholesale so that we could stock our shelves? And that makes sense, right? Who understands that whole entire transaction as far as retail is concerned, that, hey, someone comes in, buys something for X price, and then what happens is the store is left with money, and then the store goes back to the manufacturers and gets more stuff at a lower price and restocks the shelves, and life goes on, so that my wife could come back in 2 weeks and buy them all out of it again, okay? So now here's the thing. What people don't realize is they go like this. They go, Stu, the banks have all this money that they could just be giving out to borrowers, right? But go girl. Yeah, trust me, she's as soon as it's feasible for her to go back into Macy's in Manhattan, she's going to be there and she's going to be swiping that Macy's card left and right. So, the bank has all this money in their shelves, just like Macy's has all of these products in the store, okay? But then what happens is, here's where people get confused. They go, well, the bank's product is money, right? The bank's product is money. So what happens when there's no more money? Well, unlike this scenario where they're left with money and they go buy a product, what happens is this. The bank is left with two things, a note and a mortgage. Now, this $100,000 over time, okay, is going to be paid back, okay, and they're going to make more money. Someone said, I got it. Your wife sounds like me. Yeah, absolutely. So this is what I'll tell you. So the bank is left with the note and the mortgage, which what happens is they could service that over 30 years and get all this money back. But here's what happens. They would probably have to close the bank down because they wouldn't have any more money to give out to buyers. And then we would have sad face buyers who'd be like, well, you have no more money? Yeah, there's no more money. Okay, so what happens is this. The banks have to sit there and say to the other folks, hey, we need to figure out how we get more money and how we trade these notes and mortgages in for money. So what they do is they go to the secondary market and they sell the note and the mortgage on the secondary market. Now, typically they sell it for, so you're probably sitting there going, well, why would someone want to buy it? Well, here's what happens. Fannie Mae, Freddie Mac, and Ginnie Mae are all entities on the secondary market, okay? Fannie Mae is the largest. Fannie has the largest Fannie. I always say that. Fannie has the largest Fannie. So Fannie Mae is the largest on the secondary market. They buy 1 out of 10 mortgages, and that doesn't sound like a lot, but if you think about that realistically, that's a metric boatload of mortgages that they buy. So they buy notes and mortgages, and what they do is they package them for investors. So people who have all this money sitting at home, and they're like, hey, do you want something that's somewhat reliable? We have all these mortgages and notes that we invest in, and the money comes back to us over time. So what happens is investors invest in Fannie Mae, Freddie Mac, okay? Now, Ginnie is a special little person. Who knows? So here's what I'll tell you. Let me do this. Let me oversimplify Fannie and Freddie for you. I said Fannie was the largest purchaser of mortgages on the secondary market. Freddie is a smaller Fannie, okay? So what is Ginnie's role in the secondary market? What is Ginnie's role? Ginnie has a unique role. Okay, they're the government entity. Brenda just said that they're the government entity. Absolutely. So what do they do? So I just said that Fannie and Freddie purchase mortgages, okay? I was just taking a sip. So someone said they purchase less desirable mortgages. So what happens is they don't. So here's the thing. Ginnie Mae does not lend money. So the secondary market does not lend money, okay? Understand that. Just like these wholesalers only wholesale to Macy's so that they could resell, okay? You can't buy wholesale at from those manufacturers, right? So you can't, my wife can't go to Coach and say, I'd like to buy your stuff at wholesale, please. They'd say, no. Can't do that. You could go to Macy's and buy it, regular price. So the secondary market, here's what they do, and I'm going to make it I'm going to give you an oversimplification of it, because the more because here's the thing, what I'll tell you is this. A lot of you guys, this is a little tip for the test, okay, and when you're studying. A lot of you want to know all of the nooks and crannies, and here's what I'm going to tell you. Knowing all of the nooks and crannies is not bad, but there is a point in your real estate studying that you're going to sit there and say, and you have to ask yourself, do I need this for the test? And typically, a 5,000 foot view, and what I'm saying is, when I say a 5,000 foot view, I mean like an overview, like a brief synopsis, a talking point, is really more so what you need than anything else, and having an in-depth, surgical knowledge of some things, okay? So someone said they deal with mortgages that Fannie and Freddie don't touch. No, Fannie and Freddie touch, they'll buy lower end mortgages. They will buy them, but what happens is, think of Ginnie. So Ginnie can't just buy mortgages because the government understand that the government entity, there is not enough money in the world for them to start buying up loans. Like, there's just not. So here's what happens is, for those of you who have kids, you ever hide the vegetables and things? Like, you put the corn and the peas and the mashed potatoes, and you're like, tastes so good. Yay. Get some vegetables in their system, or you bribe them with something. What happens is this. Ginnie Mae sells what's called pass-through bonds. And what it does is it actually allows, they give incentives pretty much for Fannie and Freddie to purchase some of those more undesirable loans, okay? Because again, they're not a purchasing entity. They actually are set up to basically hide the vegetables for Fannie and Freddie. Because here's the thing, Fannie and Freddie, they don't want to be purchasing those higher risk loans, okay? So what happens is Ginnie sits there to hide the vegetables, like a security company, kind of like that. That is the best answer that I could probably give you, like hiding the vegetables, security company. Yeah, they entice Fannie and Freddie to purchase some of those lower end loans. So what I'm going to do is this. I'm going to say right now that we've also identified the secondary and primary markets, because the primary market are the banks that you get the money from, right? They're Macy's. The primary market is Macy's. The secondary market is the guys behind the scene, Fannie, Freddie, and Ginnie, who purchase those notes and mortgages and service them over time, and that's how they make their money. And then in turn, the bank gets restocked with money because Fannie and Freddie are buying on the secondary market those mortgages. And here's the thing, they typically buy it for a little more. So if it's a $100,000 loan, maybe they pay the bank $110,000 for it, okay? Because still, even then, they're still gonna make a lot of money on that loan, even buying it for a little more, okay? And I gave you really an oversimplification of it, but I wanted to make sure that you understood that. So here's what I wanna do. give me a smiley face. Thank you, Stu, if that worked for you as a definition and as an explanation. And if I cleared it up for you, oh my gosh, smiley faces and thank yous abound. Awesome. That's what I'm here for. So I'm glad that that little story helped you out as far as that's concerned. So we did a lot of stuff there. Okay. We identified what a mortgage is. Okay. We identified what a promissory note or note is. Okay. Yeah, Ginny is not. So here's the thing. Ginny's not, there's not much to really read about Ginny Mae. Other than, like I said, she's just one of those that sells pass-through bonds that will entice people like the purchasing entities like Fannie and Freddie, okay? And you won't get, and here's the thing, that goes back to what I was saying a little bit ago. You will not get a question on the test that's going to be, a really in-depth Ginny question. So that's just something that, as long as you know who, honestly, your questions are probably going to be more around who's on the secondary market, like, than what they actually do. Because like I said, that's almost splitting hairs, because Fannie and Freddie are almost indecipherable amongst each other. Okay. So let's do this. Let's go into loan to value amount, PMI, that kind of stuff. And also in turn, go through FHA and VA loans. So let's talk about an FHA loan, okay? What is an FHA loan? Tell me some characteristics of an FHA loan. Like, why would I get an FHA loan? Low income buyer? Yeah. So here's what it is. You ready? I'm going to simplify it for you. Credit risk, okay? Not such a great borrower, okay? Low down payment, okay? So, oh man, and someone said insured by the government. Absolutely, this is a government insured, so it's an FHA insured loan, okay? That's why they call it an FHA loan, okay? The FHA insures it. And look, let's do this. Let me ask you another question. What is the FHA? Okay, what is the FHA? What does that stand for? Everyone always doesn't. They don't know the Federal Housing Authority, Federal Housing Administration. Yeah, I'll take administration or authority. I usually say administration, but that's so as long as you know federal housing, it's federal housing. So here's what I'm going to tell you. Okay, FHA loan. A couple things about this. You ready? Low down payment. Low. Also, FHA loans, okay, are going to have, so you're going to hear a couple different things. You're going to hear PMI and also the word MIP. So what do you need to know? MIP is for FHA loans. Why do they jumble up the letters? Because they need to confuse you even more. There's no other way around it. It's mortgage insurance premiums, show off. Yeah, I knew you would say. I knew you would know. So mortgage insurance premium is basically the PMI of FHA loans. So you're probably saying, Stu, what's PMI? And what I'll do is when I get into conventional loans, I'll tell you a little bit more about that. But basically what that is that's insurance that protects the lender, okay, that the borrower has to pay. So the lender says, hey, you have to pay this, okay, and it protects them against default, okay? And the reason why FHA loans, are able to basically say, sure, we'll take a more credit risk client, sure, we'll take a lower down payment, is because the FHA loans are insured by the government, okay? So the government insures them. So the banks on the primary market, okay, so those guys on the primary market that are lending the money out, okay, they're more apt to lend more money out and have a higher loan to value amount. So guys, you know what? Now's a great time, since Stu mentioned it. What is LTV? What is loan to value? Because I just said it just now. I said FHA has a higher loan to value typically. Okay. So loan to value is basically this. Income and debt, okay? It's the loan to value of the property. So the appraised versus what you owe. Here's what I'm going to do. I'm going to give you my definition. You ready? It's the loan amount, okay, in comparison to the value, which is the appraised or sale price, whichever is lower, okay? So the appraised or the sale price, whichever is lower in a sale, okay? So what happens is this, okay? When you have an LTV, okay, I'm going to move that right there so that you can see it nice and clearly. So let's say a home is purchased for $100,000, okay? We'll make it really nice and easy. Home is purchased for $100,000. The loan to value, let's say if we said it was 75%, okay? Well, you just multiply the percent into the loan and you would get what it is. So this one, because I used easy numbers, is a $75,000 loan, okay? So 75% of the loan, okay? If it was a 75% loan to value, would mean that the loan is $75,000. Now, loan to value is important when we start getting, so Bernadette said it's the size of the property versus the value. Has nothing to do with the size. This is strictly loan amount value. Loan amount value, strictly that, okay? So what you have here is you have a situation where the property is, again, the value of it we've set at $100,000, and we say it's a 75% loan to value. Loan is $75,000, okay? So the loan to value is basically a representation of what the loan is, you know, in regards to the value of the property, which is either the appraised or sale price, whichever is lower. Hence why you might hear some people say, hey, I have whatchamacallit, a property that underappraised. Why did it underappraise? Because what happens is the bank goes with a value that is either the sale price or the appraised price, whichever is lower. So what happens is an FHA loan, because they allow you to put only 3.5% down, they're going to have a higher loan to value amount. They're going to have 96.5, 97%, the loan to value amount. Because again, they are only asking for you to put down 3.5% in some scenarios. So they're going to take a much higher LTV, size of the mortgage versus the property. Yeah, so size of the mortgage, basically, the mortgage is 75% of the value. That's it. So did I just give you a good definition of loan to value? Tell me if that did, or if you need more clarification on it. Yes, give me a thumbs up. I love hearing that, making sure that no man left behind in the Stu crew here. Awesome. Amazing, fantastic. You guys are awesome. No, you guys are doing a great job. So here's what I'll tell you. Next one, and we kind of went over MIP, so I'm going to cross MIP out. Okay. Oh, you're quite welcome for simplifying stuff. That's what I'm here to do. So let's keep going. Let's get some more stuff in. So what is a VA loan? Okay. As I just basically, VA loan. What is that? Military. Yeah, there are requirements that you have to meet. Okay. It is given to our active military or honorably discharged military. So it's a loan for veterans. Okay. As long as they qualify. Guaranteed. I love that word. Guaranteed by the VA. Okay. So it's guaranteed by the VA. Okay. And yeah, there's no down payment that's required. Okay. No down payment required. okay? No down payment required because the VA guarantees it. They say, hey, this is a veteran. They meet the requirements of obtaining the loan. And what happens is this. They say, oh, because the VA is going to guarantee it, those lenders, okay, are going to say, yeah, sure, we could definitely, lend this to you without putting anything down because oh man, yeah, no mortgage insurance, right? Because here's the thing, why is there no mortgage insurance? Because the lenders feel a little more secure knowing that the VA is guaranteeing in certain scenarios up to 50%. Typically it's the top 25% of the loan, but in certain scenarios they are guaranteeing up to 50%. So that is the situation there with the VA loan. Now let me ask you this, guys. What is, I'm going to erasey some things. Erasey. Okay. Erasey. Didn't want to erasey that. We'll undo that. Now, here's what I want to ask you. What is a conventional loan? Okay, because we kind of got an FHA loan. We got a VA loan. What is a conventional loan? You guys have definitely some so not backed by government. Ooh, I like that one. Not government insured or guaranteed. So here's what people always say to me, and they have the harder time identifying a conventional loan, okay? Because here's what happens, okay? They always say, the conventional loan's the normal loan, is the vanilla loan. And I go, so the other ones aren't normal loans? And I said, so do you have to get them at different places? So let me ask you this. Do you have to go to special places to get an FHA or VA loan? Like, is there special places? The other ones are weird. You guys are smarty pants. Look at you guys. Yeah. So basically, here's what happens. Conventional loans, okay? The identifying thing here is they're not government insured or guaranteed. So they're not an FHA loan or a VA loan. That's it. So if it's not an FHA or VA loan, it's going to be, there are going to be higher standards to get a conventional loan. Hence why the VA one takes on more credit risk, credit averse loans, okay? Yeah, so you might find your non-conforming loans in a conventional product, right? So, and just so you know what a non-conforming loan is, because we just saw it in the chat, that is a loan that is higher than the amount that Fannie Mae will purchase on the secondary market, because Fannie Mae is such a big Fannie that she actually sits there and says, hey, in this town, in this place, I'm going to only buy, in this county, I'm only going to buy up to this amount, okay? So Fannie's she's kind of special like that. And anything is, so a non-conforming loan is a jumbo loan, yes. So Lisa, that is the same thing, okay? So that would be one of the conventional products that you would have. And that's just wrapped into stuff in here, because FHA and VA loans, we've identified them. We know what they are. We know that what they walk, talk, and act like. Also, something else I didn't mention about VA loans, that's for a veteran's primary residence, okay? And it's something that they have to, so they have to sign a document that says that they're using it as their primary residence, okay? So they cannot use it for investment properties, okay? So conventional loans are more common. It depends on the area. It really does depend on the area. It depends on the circumstances. In certain parts of the country, I'm sure the VA, FHA loans would be more prevalent. So it really depends on the situation. It's hard to say that conventional loans are more common. I will tell you that, so all FHA, yes, FHA as well. That is for primary residence. Yes. So thank you very much for adding that as well in the chat. That's why I like having the chat up. You guys are absolutely fantastic. Okay. So the conventional loans are not government insured or guaranteed. Now, something else I want to say, because I did want to tell you that we would go over PMI a little more. Okay. a little more in the conventional loan section. So PMI stands for private mortgage insurance. If you have a loan to value amount, because now we know what loan to value amount is. If you have a loan to value amount higher than 80%, okay, the lender's going to require that you take out private mortgage insurance. Okay, they're going to say, hey, you have to take out private mortgage insurance. Okay, you have to do that. Okay, and that's an annual premium that will be broken down monthly. That is responsibility of the borrower. Okay, now the same thing. The converse is MIP for FHA loans, and that operates the same way, protects the lender against default. So we've gone over what is PMI, what is MIP, what is the difference between FHA and VA. Okay, now we have to talk about what is PITI. So who knows what PITI stands for? PITI. PITI. Anybody, come on. There's someone who has this in their head. Someone knows. Principal interest rates. So principal interest. Principal interest taxes insurance. Principal interest taxes insurance. Yeah, I'll take principal interest taxes and insurance. I'll take that one. I'll take that one. That's what it stands for. Okay. So they'll actually refer to that. So someone put the Investopedia there. I love it. I love it. Principal interest taxes insurance. Yep, that's exactly what it stands for. So it's pretty simple as a dimple, right? So there's not much to really talk about with that. So whenever you see that, that's principal interest taxes insurance. Okay. So that's it. There's not much there. So now who could tell me what a point is? Because I want to round out some of the questions that you guys had once I said finance. You guys threw out all these things at me. What is a point? Typo earlier. That's okay. I knew what you're talking about. 1% of the loan. Tina, you win the gold star of the day. 1% of the loan. 1% of the loan. Okay. So 1% of the loan. Now, here's what I'm going to tell you guys. Points could be put up there for many different reasons. They could be done for buy down reasons. They could be done as fees, stuff like that. So a point on a loan is when they say you pay 1 point. Someone's saying she types faster than me in the chat. So 1 point is 1% of the loan. So that is exactly what it is. So now we have to talk about deed of trust. Okay. And we'll talk about deed of trust as well as some debits and credits. So let's go into this, shall we? Okay. So who knows what a deed of trust is as I'm doing erasey? What is a deed of trust? Yeah, so you could actually have PMI removed if you do get to a certain loan to value amount, like if the value of your home increases, right? You could definitely get PMI removed. Yes, 100%. Great follow-up to your clients, okay? So someone said that a deed of trust transfers ownership. So it's not exactly that. So there's different states. So here's what I'm going to tell you. A deed of trust is similar to a mortgage situation. You ready? And I'm going to draw some things for you, okay? So let's do this. You have the bank, okay? Remember banco with money. Then you have a borrower, okay, who's super happy to get the money, okay? They get the money. Now what happens is I told you about a mortgage transaction. And what did we say that the mortgage transaction does? We said in a mortgage, well, a deed of trust establishes time. Oh man, you guys are writing a whole bunch of different things in there. That one was way too long to read, but I'm going to tell you my thing. You ready? So watch this. In a deed of trust transaction, you would have this. The money goes to the borrower, okay? Now, what happens is the borrower doesn't give the lender a mortgage or a promissory note. What they do is this. There's this third guy over here who just kind of is there, okay? And here's what happens. That's usually an attorney, okay? And I'll put an attorney there, or an escrow company, something like that, okay? And here's what happens. Bank gives the borrower money. The bank is referred to as the beneficiary, okay? And instead of the bank saying, hey, I want to have a mortgage to the property, I want you to pledge it as collateral for the repayment of the loan, what happens is this. The borrower gives legal title, okay? They give legal title to the property, okay, to the trustee, who's this attorney, okay? Now, EE receives, OR gives. So the borrower is going to be referred to as the trustor. So here's the thing. This is the entire difference between deed of trust and a mortgage transaction. On the surface, it looks all the same. On the surface, it looks all the same. But what happens is the only time that it would be different is if you had to foreclose. Let's say beneficiary wasn't getting the money back, wasn't getting the payments back from the borrower. The beneficiary would go to the trustee who's just sitting there holding legal title to the home and say, hey, we need to sell that property to foreclose on it so that we could get the get our money back. We need this money back because the borrower is not paying us, okay? So Dretta wrote, does the borrower hold equitable title? 1,000 million %. They hold equitable title, which means, and here's the difference between equitable title and legal title. Legal title is actually holding title to the property, so the trustee holds title to the property. When we refer to equitable title, we basically say the buyer has the opportunity to get legal title at some later date and point, okay? So that's the, someone said the best $20 I've ever spent. Thank you so much. I try to make it the best bang for your buck. I really appreciate that. So I just want you to know that legal title is actually holding title. Equitable title says, yes, I have a future interest where I might be able to get full legal title. So what happens is if it's all paid off, all the money's back where it needs to be, the trustee is going to send over a reconveyance deed and actually give legal title right back to the borrower. So that is right there, 1,000% a deed of trust. I'm giving you the 5,000-foot view because it's not used in every state. Some books just have a paragraph on a deed of trust. Some books have pages on it. It really depends on geographically where you are in our fine, fantastic, wonderful country. So I've also identified for you the deed of trust, okay? When does this normally occur when you first buy the property? You're talking about deed of trust or Wendell? Okay, deed of trust. So here's the thing. It's really a state-specific thing. So this is in lieu of a mortgage. So it's either you're going to have a mortgage transaction or a deed of trust. So, and it really depends on the geographical location of where you are, you know, kind of like the old saying, when in Rome, okay? So depending on where you are, if you buy a home out on the East Coast, like in New Jersey, you're probably going to have a mortgage transaction. If you are out on the West Coast, you will have, you will have a situation where you will have probably a deed of trust. So someone said, how often do you do this? I want to be a regular. I offer my private lessons on a regular basis. This I typically do, just so you guys know. This is a new thing for me because what happened was at my school, I used to offer a weekend crash course that was like 4 or 5 hours, okay, sometimes even longer. And it was easy when you were in person because you're having lunch. It was you were mingling, you were schmoozing. Now I'm doing 2 hours on the weekends because we're via Zoom, and I do this about 2 times a month. So if you're watching this on replay at all, 2 times a month is typically when I do this, and I post in my own personal Facebook group, which you can find in any of my YouTube videos. I have a link down in the description. So if you go to my YouTube channel, you go to my any of my videos, and I'll put my website up there, helpmepassmyexam.com. I always put notifications there. So there's a lot of places that you could get notified. Also, you could always text my office, and I'm putting the number in the chat, okay? And find out when our next schedule is. I'd be more than happy to provide that to you. So thank you so much for saying that you're liking this and that you're really getting a lot out of it, but I need to keep moving so that you get more out of it, okay? So clarified what a deed of trust is. I think someone asked in the chat if I could clarify the trustee. So what happens is this: when the deed is, when the debt is paid in full, the trustee, the one who's holding legal title, the attorney that's just sitting there, okay, they sign a reconveyance deed back to the borrower. It's called a reconveyance deed, okay? So I hope that clarified it for you. So debits, credits, oh my. So debits and credits, okay? People always get these confused. Now tell me in the chat if you get debits and credits confused, because this is something that I want to make sure that I'm giving you the best bang for your buck. I'm making sure that I tell you everything that I possibly can. So who here gets these debits and credits confused? Yeah, so they are confusing. So let me explain to you what happens. And I think it's super important to understand a couple things. How does earnest money appear on the spreadsheet for the buyer? As a credit to the buyer, but let me explain why. So here's what happens. Think of it this way. You remember my wife? So you're going to remember my wife a lot because here's what I tell you. My wife returns everything. This is literally a weekend at my house starts with this. You know, I have a couple credits from Target. Do you want to go shopping? And I'm like, why do you have credits from Target? She's like, well, I bought this thing and I just didn't like the color of it, or it didn't fit right, or it didn't do this and didn't do that, okay? She spends all your money. Look, my wife is a very super intelligent doctor who graduated in Ivy League school, so she spends all of her own money, okay? But yeah, she does try to spend some of my money too, so she's not averse to that. So what happens is this: she always gets she always gets credits. So credits is money owed to you. So if I say credit the buyer, credit the seller, that's money coming to you. That's money coming to you. Okay? Debit, a debit, money gone. Money you owe. So here's what I'm going to say. Money you owe, okay? And what I will tell you is this. If we had, and I'm going to give you an oversimplified version of a closing disclosure. And also something I want to tell you too, if those of you who says, hey, I wasn't a prep agent member, this upcoming week, I'm actually going to be doing a webinar for prep agents. So I do webinars for prep agents. They're much shorter. They're only about 30 minutes long. But I do them about three times a week for all prep agent members. So if you're a member, okay, or you're like, hey, I really like this, then I do that, like I said, 3 times a week there. And I'm actually doing next week, I'm doing a webinar on an entire spreadsheet that I'm going to do. So I'm going to spend 30 minutes just on that. Okay, so let's talk about this. I'm going to give you the simplified version of it. So we have the buyer and we have the seller. Now, if we have a situation like this where the buyer says, so let's say this, let's say we wanted to make the simplest one. We would debit the buyer the sale price, and let's say it's $100,000. Stu loves that number. We would credit the seller $100,000. So what does that mean? That means if there are no other charges done at all, the buyer needs to go to an ATM and get $100,000 out of the bank and bring that to the closing table. And then the seller, if there were no other charges, no other fees, no other anythings, the seller would get credited $100,000. So if we were to oversimplify and say that that's what would happen, that's what would happen. But here's the thing. There are other things that we need to take into consideration, okay? Like the buyer might have had earnest money, right? So what is earnest money going to be shown as? Well, that's going to be shown as a credit. Let's say it was $2,000, okay? And we're not going to credit the seller. Why? Because the seller already has the $100,000. He's getting that. So anything that just goes towards the buyer not having to bring extra money to the table to account for, to deduct off of that 100,000 is just going to be on their side. So it's not going to be on the seller side at all. Does that make sense? Because think about it. If I owe someone $100,000, okay, so let's say this. Let's say I owe Brenda $100,000, right? Brenda is going to get my 100,000, okay? Brenda's getting my 100,000, but here's the thing. Let's say, you know, Brenda getting her 100,000, that's happening. But let's say I'm going to get her 100,000 by asking every single one of my members and every single one of my students to say, hey, could you give me $100? Could you give me $1,000? Well, that's all on the back end, right? That's all on mine. So if I'm getting $100 from, you know, 1,000 people, well, that all doesn't matter. That doesn't change anything on Brenda's side. Brenda's still getting her $100,000. Does that make sense now? Do you see how that's working? How we're kind of working both sides a little differently, you know? Right? Give me a thumbs up. Let me know. Give me a smiley face if you're like, oh my gosh, it's kind of coming together a little bit. You know, Stu owes Brenda all this money, and, you know, Stu's just kind of getting it, getting it from all different places. How would it show at closing? So here's what happens. You ready? And I'm going to continue this a little bit more. So seller's still getting her 100,000, right? Now, there's a $2,000 credit. There's a $2,000 credit on this side. And let's say I had a loan. I had a loan for, whatchamacallit. A lot of you guys, yeah, this is a complicated one. That's why I like to go over it a little bit. Let's say I took out a loan for $50,000, right? I had a $50,000 loan. How would that show up on the buyer side? How would a loan show up on the buyer side? Credit. Listen to why it would be a credit. Remember I told you? Remember I told you that it doesn't matter how you're basically going to get the money. So think about it. I owe the seller $100,000, right? And here's the thing. The reason why it's a credit is because that means that the bank is bringing that to the table. I don't need to bring that to the table, okay? So what happens here when you're looking at this, every single thing that I'm getting money from, every place I'm getting money from means that I don't have to go to the ATM and take that money out, okay? So the loan is going to be a credit to the buyer because that's going to be a portion of the $100,000 that they already owe. Does that make sense? Give me a smiley face if that makes sense. If you're like, ooh, yes, yes. See, I want to give you just a little bit. There we go. Okay. Someone said no. Yeah, it's hard. And that's why, like I said, it's something that you could watch this on replay, because what I'm going to do is this. There's an overwhelming amount of yeses. So I'm going to take that as a win. Okay. And again, keep in mind, I'm recording this for you guys. So you could watch this over and over again and kind of say, okay, how do I go about this? Pause it, rewind it, kind of that kind of stuff. All right. So look at all this stuff that we've already gotten done in the first hour. Okay. Yeah, it's part of the purchase price. Okay. So we've gotten, what is the point? Who is the mortgagor? We've identified all this stuff that has to do with financing, some of the bigger things out there. So we got a lot of stuff done in that first hour. So let's talk about how we're going to work with the rest of it. Another famous thing that you guys always ask for. So let's talk about this. So what we'll do is this. I'll talk about appraisals, okay? Because that was the first thing that was done. Okay, so we'll talk about appraisals, appraisal process, okay? So you guys want that. Let's also talk about contracts. I'm gonna go there next because you guys always want void, voidable, unenforceable, okay? Could I go over licensing requirements? I won't go over licensing requirements because that's state specific. That is something that I won't go over today because that's just super state specific. And then someone said, can I clarify liens? Liens, specific, general, okay. While we're doing liens, could we do easements? Yeah, let's see if we can hit on easements. And also, what about if we could do gross lease, net lease? Okay. Title. Let's see what we can do. Let's see what we can get in there. I'm just writing it all down there. Someone wants to know about the freehold estates. Okay, specifically life estate. So let me do land use regulations. So let's do land use regulations. Those would be our government powers, okay? So let's see. There's a lot of stuff there. That is very meaty. Okay, so where the right side of the page wasn't so meaty in the first hour, man, you guys really packed it in for the second hour, okay? So zoning will be under land use regulations. So I'm going to lump that all in. So let's first talk about the appraisal process, okay? So let's try to knock that out first and just kind of get everybody woke up. Yeah, they're like, oh man, this new guy's awesome. Let's make sure we get everything in there. So let's talk about this for a second. So what is an appraisal? Okay, what is an appraisal? Okay, and tenants in common is in title. So if I get the title, we're going to do that. We're going to hit on that. So what is, it's an opinion. Well, I have a lot of opinions. It's an opinion of value. Opinion of value. Okay. Okay. Guaranteed price for a bank. No, never a guarantee of anything. It's an opinion. It's an opinion. Okay. Think about it this way. My wife holds my opinion on a lot of things very, very, very low on the totem pole. Okay. So it's an opinion of value. Okay. It's an opinion of value given by a licensed appraiser. You got to be a licensed appraiser. Okay, they got to be a licensed appraiser to give an appraisal. Otherwise, it has to be called something else. Okay, so I think that what we have to talk about a little bit is the three approaches to value that you would get. And what I'm going to do is this. I'm going to talk about the three approaches to value that have to be considered. Now, I'm going to also explain to you a little bit about how the process works. Okay, and the process works a little bit like this. People always say, you know, why do you say that the appraiser has to consider the three approaches to value? And what happens is this, they have to consider the three approaches to value in their narrative. And when I say narrative, that's basically their written report. They're not going to use every approach to value. So the first one, and also keep this in mind too, your instructors, okay, they might have taught you a certain way and they might have taught you a certain wording. Let your wording be a little more fluid because what happens is there's a lot of times that there are synonyms for certain things. And when I say synonyms, I mean things that mean the same thing. I mean like, hey, we could use this or that. So the first approach to value would be the market data or the sales comparison approach. I usually say market data approach, okay? Because that's in the way that I was taught, that's how I always used it. So but I've since also used the sales comparison approach because some authors to questions will write it as such. So what type of homes are we going to use the sales comparison approach in? Residential. Yeah, residential homes are really like the common one. Residential. Okay. Now here's how this works typically. So understand two things. There's always a subject property. So what's the subject property? What's the subject property? Someone said the one being sold. I like a different terminology better. I like a different one. The property you are appraising, the property that you are appraising, that's the one that I really like. Okay. The property that's being appraised. Because here's the thing. Let me ask you this, because I think this is an important question to ask. Why do we do an appraisal? Like, what are the reasons why an appraisal would be ordered? Write that into the chat. Why do we use an appraisal? To find the value of a property. But let me ask you this. Why would we want to find the value of a property? Why would I want to pay someone to appraise it? So selling a house for a loan. Yeah, there's a bunch of different things. Insurance purposes, right? So here's the thing. That's why I don't want you to think that this is always with a sale, because there's other times too that you might want to have an appraised value of a home. Okay. So here's what happens. The subject property is always the one that we don't know the value of, right? And what happens is, in a sales comparison or resident or market data approach, you would get comp 1, comp 2, comp 3, all these different comparables. And here's what you do. And when I say you, the appraiser, okay, they would find out, is the comparable superior or inferior to the subject property? And if it was superior, all right, so if something is superior, we assume that it sells for more. So if it is superior, we would adjust the comparable down for that line item. Meaning, if it had an extra bedroom, so if comp 1, comp 2, comp 3 had an extra bedroom, we would say, okay, it was superior, so it probably sold for more, and we're going to adjust it down. So on the bedroom line, and here's the other thing too, a lot of people always ask me, Stu, how does Mr. or Mrs. Appraiser find out how much they adjust it down for? Okay, and remember this, okay? If if an appraiser says I need to adjust it, they're going to adjust based on their opinion, okay? Opinion. Oh, Ruby just wrote in, the subject property never gets adjusted. Bang, boom, drop the mic. Yeah, it never gets adjusted. Do you know why? Because you don't know the price of it. All the comparables, and it's good to note this, all the comparables are all sold, right? Are all sold. So what happens is this. If the comparable is superior, the appraiser would adjust it for that line item, the bedrooms, down. If it is inferior, meaning it had less bedrooms, he would adjust it up. Now, that being said, that is really what you need to know about the sales comparison approach. He'll adjust all of the comparables and then come up with one value. And always in an appraisal, it is one value, never a range, okay? Okay, never a range, never a potential, whatchamacallit, never a potential, space of price range or something like that. Never do that, okay? It will always come up with one price, okay? So let's look at the next one. The next one, because like I said, I'm giving you the overview so that hopefully we could get through a lot of this stuff. The next one is going to be the cost approach. When would I use the cost approach? When would I use the cost approach? Unique properties, special use properties. What do you mean by special use properties? Okay. Churches, firehouses, special properties, libraries, things like that. Okay. So the cost approach is going to be for special use properties. Also, it will be for post office. It'll be for new construction when there is no other, when there's no other whatchamacallit, like properties to compare to. So if I'm building a new construction and there's just nothing I could use as comparables, okay, comp 1, comp 2, comp 3, I'm probably going to use the cost approach, okay? Hospitals, depending on the circumstances, hospitals could be used on the cost approach. And I say depending on the circumstances because they could be considered, they could be in buildings that are income producing. So it depends. Okay, some of them are public buildings, some of them are done through grants and all that kind of stuff. So like hospitals, I put like a little asterisk next to. It's not as good an example as a school, but I could definitely make the argument for it. So I could see that. So how do we do the cost approach? Like what? Like okay, I'm an appraiser. Okay, tell me what do I do? What do I do? So here's what I'm going to do. I take the total cost of the building, okay, minus depreciation. And then you add it to the value of the lands. There are 3 different types of depreciation, okay? 3 different types of depreciation. What are 3 different types of depreciation? What are they? Someone asked, if you have multiple police buildings in a town, do you still use the cost approach? Unless they've all sold within 6 months, yeah, you're using the cost approach because the likelihood of, okay, if you have multiple police stations in town, typically you're not selling them, okay? Typically you're not selling them, so cost approach still would probably be the most appropriate. Again, not saying that there isn't a world or a town or a time that there actually might be a way to use the market data approach. Hence why you have to consider as an appraiser all of the approaches to value because depending on the circumstances, there might be an outlier situation. However, it would be such a freakonomics kind of thing that I haven't seen a good example of that. But again, and that's me taking all these years of education. So yeah, we have physical deterioration. And these are your types of depreciation. Functional obsolescence and economic obsolescence. So what's economic obsolescence? What's economic obsolescence? Someone said can't be cured. It's things outside the property. Right. So if someone has, let's say they build an airport down the road from me, okay? Oh my gosh, that's going to negatively impact my property. We're going to depreciate the property because of that, okay? Things that you can't control. Yeah, that's economic obsolescence. Good job, guys. You guys are such smarty pants. What about functional obsolescence? Functional obsolescence. Do you want another analogy involving my wife? Functional obsolescence. That's when the function of the home is not updated. 5 bedrooms, 1 bath. Yeah, that would be one. Or what my wife always says about our home, because so you know she likes to shop at Macy's, right? You know she likes to shop at Macy's. So my wife has, we live in a house that was built in the 70s, and we have closets that are tiny, tiny, tiny. They wouldn't be built today the way that they are right now. So the functionality of it has deteriorated, kind of like when I told her, so like when we first started dating, if you want to hear about one of the fights that we had, I didn't understand why she needed more closet space because I said to her, I said, hey, you only wear scrubs to work. I was like, so how much clothes do you really need? So apparently that's not what you say to a young lady. You do not tell them that. So now I've been banished to, I have like borderline half a closet. Okay. So even though she wears scrubs to work, that is not something you say. CMA versus market data. Is CMA for the agent to provide to the buyer? So that's a great question, actually. I want to address that right now before I go into physical deterioration. So I think we know functional and economic obsolescence. So a CMA is a comparative market analysis, because remember I told you that you have to be a licensed appraiser in order to call it an appraisal, okay? So a CMA is a comparative market analysis, and in many ways, because of comparative market analysis, you're not bound to the confines of an appraisal, like where you have to find sold comparables. So in an appraisal, the appraiser has to get sold comparables in the market data or sales comparison approach. A CMA is provided by anyone who would not be who would be like a real estate professional, real estate broker, preparing a market analysis of value, okay, that is not an appraisal, okay? But in some ways, it could be more dynamic than a appraisal could be, because if you're in a very, very hot market, okay, and things are selling left and right, see what happens is this: an appraisal, that's going to be a snapshot of like maybe 6 months ago, or even like a year, you know. So it's a snapshot of a time in history, whereas opposed to a CMA could take into consideration some things like current market conditions, sold, expired, active comparables. So a CMA, in my opinion, has some more value to it than an appraisal might. So I hope that answered that question for you, Samantha, because I want to make sure that I got that in there, because I thought that was a really good question. So thank you for that. And thank you for keeping me honest. And also, let's talk about physical deterioration. Okay, physical deterioration. So if you ever gone to a house and you're like, that house, that's not so good. You see the roof has some shingles missing, okay, wear, tear, tree roots. And typically, so here's the thing, a lot of you are using the terminology curable, incurable, right? So physical deterioration typically has some curable to it. So what's the difference between something that we would say is curable and something that is incurable? Can you guys type that in there? Gives me a chance to, okay, Joretta put the cost, and I hope I'm pronouncing the name correctly too, and I apologize if I'm not. So the curable, so here's the thing: curable and incurable typically can both be repaired, except for external or economic obsolescence. Incurable things are not worth fixing, okay? Incurable things are not worth fixing, okay? That means that if it's incurable, the cost to fix it or repair it versus the whatchamacallit, the value that you would get back makes it incurable. Someone said like beams, like major cracks in the foundation. Yeah, totally, a lot of money to repair, not a lot of value bringing it back, okay? The next thing is going to be something that's curable. So like chipping paint or doing regular maintenance on the home. Yeah, that's going to be something that I would consider. So physical deterioration typically has some curability to it, as long as it's not a foundation-based issue, okay? So that is the situation there. Yeah, they do love to give you foundation questions, because foundation truly has some incurability to it. So let's go to the last of the appraisal approaches, and that's going to be the income approach. Now, I'm going to give you the simple as a dimple explanation of this one. So when is this usually used? When do we use the income approach? Commercial properties? Yeah, so like investment properties. / commercial. And I usually say commercial, because here's the thing. If you're using a single family residential home as an investment, that's great. That's fantastic. Probably going to use the market data or sales comparison approach, because that's still the best approach to value, okay, as opposed to the income approach. So what the income approach basically does is it uses one of two methods, okay, one of two methods. Method one, it'll use the capitalization rate. Method two, it'll use the gross rent multiplier rate, okay? Now, going into those, again, I want to touch on a lot of the other things that you guys want me to, so I won't take a deeper dive into that. Something I've been tossing up, and I want to know the feedback in the chat. if this would be too much of a mind melt or not. I want your feedback on this. I've been thinking about doing a 2-hour webinar just on math for those states that have math as a component to their tests. So if this is something that you would do a 2-hour torture session, then I will definitely keep you posted about that and let you know that we would be doing a 2-hour math session. So, and that's going to be, whew, buckle in for that one. Okay. So I'll see what we can do about that. So seems like that's a resounding yes from you guys. Okay. Someone said hi, Callie. Yeah. California has no math in it whatsoever. So any of our Cali students seeing this, so could I do it soon? Potentially. I have to work on that. Okay. I have to work on that. So we'll see. This is all works in progress. So I do this as it comes about. Okay. So that being said, before the 9th, I'm probably not doing it before the 9th. I can tell you that with a certainty. So let's talk about, so we've done appraisals now, right? Okay. We've done appraisals. Okay. So now let's go into contracts, because I think you guys do need to talk about contracts, because this is something that's always a constant. Hey, could you clarify this? Hey, can you go over this? And even when I go over it, you say, hey, can you go over it again? So let's talk about this. So contracts are either a couple things. So what do we need for a valid contract? That's going to be clock. Do you know what that stands for, that acronym? Who knows what the acronym clock stands for? So yeah, Jersey does have math, yes. So it's competent parties, legality of the object, okay, offer and acceptance, also known as a meeting of the minds, okay, and consideration, okay, and that could be good or valuable. So what do I mean by good or valuable? Okay, what do I mean by good or valuable? Talk to me about that for a second. What do I mean by good or valuable? A hug? I'll buy your home for a hug. Brenda, that's fantastic. That would be considered good consideration, right? That would be considered good consideration, like love and affection. Okay, a diamond ring would definitely be valuable, yeah. So we could have money, we could have anything of value, a hug, a penny. A penny's valuable, yeah. So in order to have a valid contract, we must have some sort of consideration, either good or valuable. We have to have competent parties, legality of the object. I want to talk about legality of the object for a little bit. Legality of the object, we either have to have it for a, whatchamacallit, we either have to have it for a legal purpose, okay? So like if I said to you, hey, could you sell this 5 pounds of heroin for me? You would sit there and be like, no, that's not a legal object. I can't do that. That's not a valid contract then, okay? Right, it'll be void. We'll get to that in a second. Also, if I said to you, hey, I would like to buy your house, totally legal, with 5 pounds of heroin, you'd be like, no, can't do that. Okay, so legality of the object, either the objective of the contract or a component of it, right? So contracts could either be one of a couple things, okay? The contract could be one of a couple things. It could be unilateral or bilateral, okay? What does unilateral or bilateral mean? Tell me what unilateral means. Unilateral is binding to one party. Unilateral, binding to one party. Okay. Bilateral is promise for a promise. Okay. So what I always like to say is this. You ready? A lost dog poster that has a reward, you know, lost dog, Fluffy, $500 reward. That's an example of a unilateral contract. You can engage in that for the reward. However, you cannot. But if you do find Fluffy, the owner is bound to give you that money, right? They have to give you the money, honey, for finding that dog, for finding Fluffy McFluffersons. Okay, so let's see what else. I like a lot of option contracts, not an opinion contract. Now, let me tell you this. Let's do the other thing that a contract could be. It could either be express or implied. Okay. So what's the difference between express and implied? Okay. So Ruby wrote a good question. Okay. If you find the dog, does it turn bilateral? So what happens is, yes, it basically does turn bilateral at that point, because then you find the dog, you hand the dog in. That's your part. That's your promise. And the promise is going to be that, the dog for the money, right? So that is bilateral. So express could be written or oral. So yeah, express is when the terms are clearly defined. Okay. So when I clearly define the terms, what that means is this. We could do this orally or we could do it written. So what happens with an express contract, let's say, now I have a couple of collections. I collect fountain pens. I collect playing cards. Yes, 52 playing cards. I collect playing cards, and there's a big culture on that. If you want to have some fun and see all the different things you could collect, it's absolutely insane. When I got into it, my wife was like, "You're collecting playing cards, like ace, queen, king?" I said, "Yes." So I collect playing cards. So let's say someone saw one of my decks of cards and said, "Oh my gosh, you have one of those? I would love to buy that off you for $50. Okay. I say, "Sure, I will sell that to you for $50. Okay. That is an express oral contract. We didn't put it in writing. We just said it to each other. "Hey, I'd like to buy that from you." "Sure, I'll do that for you." Implied contracts, okay, understood through actions. So I think one of you put down my favorite one, okay, buying something from a store. Basically, here's what happens. If I go to a restaurant and I say, "Hey, I would love to get the steak. Let me get that steak." So the implication there is me sitting down, ordering the steak means that I will pay for the steak, okay, after I'm done eating it. Right? So that is basically an express or implied contract, okay? Now let me ask you this. Real estate contracts, do they have to be in writing? Can real estate contracts be oral for the purchase of real estate? So they must be in writing, yeah. And what's the law that says that they must be in writing? Statute of fraudsters. I hope that was a typo, but the statute of frauds. That made me laugh. So someone said, someone said this. You could have an oral contract to buy a property, but it wouldn't be enforceable. Ooh, I kind of like that. That kind of was an interesting take on it. So let's talk about this. Let's talk about void, voidable, enforceable, okay, and unenforceable, because people always get these confused. Let me ask you this. How many of you guys get this stuff confused on the test? Yeah, me, everybody. Someone raised their hand, said, "Yes, me." Everyone gets this confused. So let me try to unconfuse it for you. Void, illegal component. Okay? As soon as it has, so Angela wrote, especially enforceable and unenforceable. I love that one. And actually, let me kind of clarify the enforceable and unenforceable. That's probably the one that's the hardest ones to get. Okay? So, a void contract has an illegal component. It could never, as it is written or expressed, be acted on. Okay, be acted on. Okay, so again, illegal component. Like, sell this heroin for me. I want to buy your house for heroin. You know, no, 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 can't ever happen. There is no way that it gets off the ground. Okay, so void has an illegal component and it can never be acted on. Okay, so a void doesn't necessarily lack one of the essentials, right? There's always an illegal component in it, because here's the thing. You ready? Let me actually say that, because someone wrote that in there and I want to actually clarify that. So an unenforceable contract basically means that basically it's right now as it stands, it can't be enforced, okay, as its current state. So what happens is this: a void contract could never be acted on, okay? Never. An unenforceable contract basically means it's a meh contract. I always say that. It's like okay, it might be able to. So if it lacks one of the four components, so let's say this: we have competent parties, legality of the object, but we don't have offer and acceptance, but we do have consideration. So someone wrote, is void and unenforceable the same? See, here's the thing. This is my comeback to everyone who says, asks if they're the same. No, they're not, because void means it can never be acted on. Like, acting on it would be illegal, would be criminal, would be something that you cannot do. No, okay? It means the contract could never be valid, okay? Unenforceable may be negotiated, might be able to be turned into an enforceable contract, right? So an unenforceable contract, let me show you. I don't have offer and acceptance. So if I don't have a meeting of the minds or offer and acceptance, what happens is this. I would be able to, at some point, obtain offer and acceptance and make this a valid enforceable contract. So a valid enforceable contract is all systems go. Could be enforced in a court of law, okay? An unenforceable, seemingly, actually, no. Let me change that word. Don't like that. Would be, won't be able to be enforceable in court, okay? So let me give you an example of one that would be unenforceable. Like I said, there's no offer and acceptance. Also, a verbal offer to purchase a home, okay? I think Khalid, or I hope I pronounced that right too, they said, an oral contract for a house, okay? Oral contract for a house. Yeah, an oral contract for a house, because guess what? There's no legal component in there. There's no reason why you say that it would be void, right? Because these are two different things. So it wouldn't be void, but a court of law would say, yeah, we won't be able to enforce it in court, but, and here's the thing, this is the but there, but you could do this amongst yourself. So what they say is this: they also call unenforceable contracts, listen to what they call it in legal terms. They call it enforceable amongst parties. Meaning, if you want to go forward with it, cool, go forward with it, okay? So Kim's iPad wrote in, what about a contract with a minor who turns legal age 10 days before the closing? Yeah, totally cool. Totally cool. Totally cool. You know, as long as at the time that it's executed and done, they are of legal age. So here's the thing. You ready? Let's talk about this. And that's also like one of those trick gotcha questions. So if you see that on the test, okay, and you ever meet the person who wrote that question, like let's say you're just sitting down at dinner one night and you're at a fine cocktail dinner and you're sipping on, you know, a nice Chardonnay, and then all of a sudden someone says to you, oh, you took the real estate contract test? Oh, I was the author of the question that said, oh, if they're legal 10 days before the contract is executed, you have the right to stop right there and slap them in the face and go, you are an evil man or woman. Okay, so you have the right to do that. You have my permission, absolutely. And you could say Stu told me I could do that, and that was for him. Okay, so and you'll get some sort of, you know, you'll feel better about yourself, because that's really like a trick evil question that like, and that's, I say that because there are authors. You have to understand there are multiple authors to the question. So this is kind of like, I'm going to give you a little test taking 101 right now, before we go into voidable. Okay. So what happens is this: test taking 101. I want you to understand that the questions are written as such. So because I used to write test questions, and the questions are written so that if a student were to go to a teacher and bring them the test and say, I don't understand this question, the teacher would be able to reference back to the question and say, it's there, you just have to reread it. If the question needs, like if the student needs to bring it to the teacher and the teacher needs to go, oh, well, here's what they mean by that, then it is a bad question. Okay? So here's the thing. Everything that you need to pass the question and to get it right is in the question. There's nothing you need to add. So if it says the black dog is walking across the street, what color is the dog? You don't go, well, could it actually be gray? No, like answer the question they're asking you. Like don't add any extra stuff, okay? It's like my wife, bless her little heart, bless her little heart. I'll tell you this. My wife is the first person that she always wanted to get like a really expensive steak. So I took her to get an expensive steak once, okay? And expensive to the point that the chef actually brings it out, okay? So that's how bougie the steak was, okay? And listen, my story has a point, okay? And listen, your brain loves stories, okay? So what happens is this, you'll remember my story. So the chef is putting the plate down and she literally reaches for the salt, okay, before she even tastes the steak. And I kid you not, the chef smacked her wrist. And I almost spit my water out. And I laughed so hard. And I said to her, I said, you don't do that. I said, you have to taste the steak. I said, and also, I said, I looked at the chef. I said, probably with the steak that we're buying right now, I said, it's probably seasoned perfectly. And it's probably doesn't need any salt. So that's why he just slapped her wrist and told you no. Okay. You don't ruin his thing. So guess what? Treat the question like the expensive steak. Don't add any of your extra stuff. Don't add a story that is not there. Okay. And the chef said, looked at me, laughed, and said, thank you. And he walked away. So that's my steak story. And we have never had an expensive steak dinner ever again. So that is the story there. But let's talk about voidable. Since we took our little detour, I told you a little test taking tip because I want to make sure you have that kind of stuff. Okay. So voidable means one party can disaffirm or rescind. Those are the verbiage that they'll use. So a contract with a minor can be voided on the part of the minor. Listen to what I'm going to tell you. You're probably sitting there and saying, well, in our state, it's not legal to have a contract with a minor. Then it would be void, okay? If the contract is illegal, then it is void. If it is with a minor and it's not for an illegal purpose, then it is voidable as long as it's legal for you to have a contract with whatchamacallit, as long as it's legal for you to have a contract with that person, okay? So let me give you another example of void versus voidable, okay? And this one's a common one for the test. So perk your ears up. If you've tuned me out this whole time, which I hope you haven't, listen up right now. You ready? A contract with someone who is declared legally incompetent is void. They could never, if declared legally incompetent, they could never be competent, okay? Is void. You cannot enter into a contract with them. Now, let's say I take my buddy JJ, okay, out for a drink. And me and JJ are sitting there going, hey, let's have 7 drinks. And he goes, okie dokie. And I said to him, I said, would you like to buy my guitar for $700? And he goes, yes. And we agree to it, handshake. And then the next day, I walk up to his house with the guitar. And he goes, I still feel a little hungover. Can you come back tomorrow? And I say, sure. I come back tomorrow. And he goes, okay, yeah, let's do it. I'm not hungover anymore. That means that JJ could at some point, he had the right to void the contract because he wasn't competent at the time, okay? Voidable because he was drunk as a skunk, and so was I, right? But more so JJ, because JJ probably drank more than me, okay? So he could have rescinded that. Now, if JJ was declared legally incompetent, he would never be able to say, no, I'm done this. Yeah, so for those of you who don't know me, I am a Shirley Temple addict, and if you haven't had a Shirley Temple as an adult, if you want to get weird looks, okay, at a bar, order a Shirley Temple and chicken fingers. But I'll be honest with you, you'll probably have the best meal that you've had in a long time. So, because I will tell you this, even the worst restaurant could never screw that up. Okay? Never. There's a reason why kids order that all the time, and they are smarter than us. Always remember that. So, I just got contracts done for you guys. So we had a little fun there. We had contracts done, right? Now, let's go into freehold estates, shall we? Because I think that that's something that I really want to get into, okay? Freehold estates, okay? So what are freehold estates? Freehold estates, listen to me, every single one is ownership, okay? Every single one is ownership, meaning full bundle of rights. What is the full bundle of rights? What is the full bundle of rights? The full bundle of rights is, I always remember it as PITI, which is poutine. That's right. It's the closest thing to poutine, and poutine is delicious, delicious for Jersey people. That's disco fries. For everyone else, that's fries with gravy and melted cheese. Okay, poutine. So that's a right of possession, use, transfer, exclusion, and encumber. So you have all those rights when you have the right to own the property. And here's the thing: your instructor might have taught you a different way. Okay, Deep Sea might have been the one that they did, and you'll notice that in there, there's basically synonyms for all that stuff, right? There's synonyms for all the words, so they're all there in some manner, shape, or form. It's just you get the full bundle of rights, right? You get the full bundle of rights. So we have several different freehold estates. Let's talk about the first one. Fee simple, fee absolute. Okay. So, or fee simple absolute, sometimes you'll see it as, there's a lot of synonyms for it. So what is this? This is the highest and best form of ownership. Okay. The only limitations that you have from fee simple absolute or fee absolute is going to be that of government powers. So zoning regulations, stuff like that. Those are the things that you would have, the things that would limit your ownership, right? So let me give you an example. I own a cute little beach house, okay? I can't all of a sudden say, you know what? Go to Mrs. Stu and say to her, I'm going to construct a 90-foot billboard that says Stu's awesome, amazing real estate education. Please sign up here, okay? No, I couldn't do that. Why couldn't I do that? Why couldn't I do that? I couldn't do that because of zoning regulations, because of the police power, right? The government holds police power over my property that says, no, you can't do that. You ever see the commercials with Geico Dikembe Mutombo just slapping things out of people's hands going, no, doing the finger wag? That's basically police powers and zoning. So fee simple and fee simple absolute, basically the only thing that limits you is the government doing a Dikembe Mutombo finger wag in your face going, no. So that's the only limit that you would have. Okay, for those of you who haven't seen those commercials, those are probably one of my favorites. I laugh every single time I see them. So anyway, I digress. Next one is a life estate. A life estate. So what is a life estate? Tell me what a life estate is, guys. Life estate. So yeah, so you ready? It's ownership based on the life of someone or something. So yeah, so pour autre vie, okay? Love that you're using the fancy pants words, okay? So bonus points to you for using the fancy pants words. Pour autre vie, okay, is a life estate for based on the life of another. So here's the thing, the wording of your questions, listen to me. Listen, listen. Ready? Let me explain the wording and make it simple. If the question says, Bob gives Sally a life estate, assume that it is based on Sally's life estate. Sally's life. So if it simply says, Bob gives Sally a life estate. So Will said, so as long as the cat is alive, you can live here. Yeah, you better feed that cat really well. You better. It's not that you could live here. So here's the thing. What did I say our freehold estates are? I said they're ownership. So this isn't like a lease, right? So what happens is this. This isn't like a lease. This is ownership, okay? Ownership. So Will, the thing that I would say is that it doesn't say you can live here. It's you can own this with the full bundle of rights. Boom. As long as Fluffy McFluffersons is alive, okay? So back to my example. If I said Bob gives Sally a life estate, it's based on Sally's life. If it said Bob gives Sally a life estate, okay, based on the life of Grandpa, then what happens is this. That is a life estate pour autre vie, okay? That is a life estate pour autre vie. So Kuwait said, can I sell the life estate? Let me ask you this. Can you? What did I say a life estate was? So a lot of people are saying no, yes, no, yes, no. So here's the thing. Listen up. Listen up. I said that a life estate, that all the freehold estates are ownership. Can you transfer when you own it? Yes, you can. But what you're transferring is you're transferring a limited ownership that terminates upon the death of Grandpa, upon the death of Sally, upon the death of Fluffy McFluffersons. So what you're selling to them is something that does not hold as much value as a fee simple absolute. However, the question that you asked is, can you? The answer to that is yes, you can, right? But what happens is what happens after that. So you can transfer, you can lease it. So Melissa said it cannot be willed. It cannot be willed if the person who has the life estate, like this one, Bob to Sally, we're assuming it's based on Sally's life, so she cannot devise it, okay? She cannot devise it, okay? However, she can, let me make it more complicated for you. She could sell it to someone who could devise it because it's based on someone else. It's based on Sally's life. So the only one who cannot devise it and devises to will real property is the one whose life it's based on. Because what happens is there's an automatic termination at the time that that person's life ceases to exist. Okay? That is how you have to make sense out of this. Is really in a life estate question, you have to figure out whose life is it based on. And here's the thing. In most life estates, it reverts back to Bob, okay? In most life estates, it reverts back to Bob. That interest that Bob has, if it reverts back to him, is called a reversionary interest. A reversionary interest, okay? That is... no, not a remainder man. That's reversion. Reversion. When it reverses, it is reversionary. Reversionary. Goes to the original owner. Goes to the Bob. Now, let's say this. Let's say it said, Bob gives Sally a life estate, and upon her death, it goes to, let's say, Paul. Okay? Goes to Paul. Paul is a remainder man because he's left over, right? He's kind of hanging out there, right? So what happens is if in the original scenario, it's a reversionary, it reverts back to Bob. In this scenario, whether it's the life estate based on Sally or Grandpa, and it goes to Paul, Paul is a remainder man, right? If it's the example where I said Grandpa, that is a life estate per Otravy with a remainder man. If it's Bob to Sally, how I would write that as a test writer is Bob gives Sally a life estate that would go to Paul at the time of Sally's death. Paul is a remainder man. Okay. Does that make sense, guys? Did I clear up life estates for you? Give me a smiley face. Let me know. Let me know. Okay. Yes. Yes. That's what I like to see. Last one that we're going to do in freehold estates is fee defeasible. Fee defeasible. Okay. So fee defeasible is this. Okay. That's ownership with conditions. And what do I mean by conditions? Tell me what, and here's the thing. The reason why, does anyone know what defeasible means? It's actually, so here's the thing. The funny thing about all this is that typically in the, Tina, give yourself a gold star. What it is this. It means defeasible means that it could be defeated, right? And here's the thing, a lot of times in the words, in the definitions of things, like when you're talking about exclusive agency, exclusive right to sell, the explanation of what it is basically right there in the title. It's in the name of it. So fee defeasible basically means ownership that can be defeated, okay? So ownership that could be defeated is going to be what we're talking about with fee defeasible, meaning if I gave you ownership and I said, hey, you have that ownership as long as you don't sell alcohol there, okay? The moment you sell alcohol there is the moment that your ownership goes bye-bye. Your ownership goes no more, all right? So that is the situation with fee defeasible ownership. That's ownership that is based on a condition. So the question that I always get asked, Stu, can you sell it? Could you transfer it? Could you do all this kind of stuff? What's the answer to that? Boys and girls of the good church. What is the answer to that? Yes, you own it. In every single word, any court indefeasible, I'm not understanding that question, Jaretta. So if you could just clarify that question. Yeah, so anytime you see any of your freehold estates, that means that it's ownership. So you could lease it. So let me ask you this. If I said that in freehold estates, you have the full bundle of rights, when you have a leasehold estate, okay, when you have a leasehold estate, also known as a less than freehold estate, what do you have? If they don't abide by conditions, does the owner have to take it to court? Yes. Yes, there would have to be that. So a lot of people are writing in, they have possession and the right to use. So they have possession and the right to use. So basically what happens in a lease is the owner, the freehold estate owner, okay, is giving up these two things, not the right to transfer, exclude, and encumber. Do you see that? So the difference between freehold and less than freehold is in a less than freehold, the freehold owner is saying, hey, I'll give to you, lessee, the one who takes the lease, I'll give you the right to basically use my property and possess it for the length of this lease. So since I talked about freehold estates and life estates, boom, we got that down. I'm really happy about that. Let's talk about a gross lease. What's a gross lease? So what is a gross lease? So a gross lease is a lease that we would traditionally find in a residential home, in some commercial units, where there's just a flat fee. Okay, standard vanilla lease. A gross lease just basically encompasses all the stuff, right? It's a fixed price. Yeah, there's not really much to it. It's a normal vanilla plain Jane lease. Rent this for X amount a month. Yep, cool, awesome. You know, bee's knees. I have a gross lease. I rent a little office space in a little. It's a little cubby hole. I call it the cubby hole. But it's a place for me to get away where there's no dogs barking, there's no things going on, and I could just go there, sit there, and go, ah. And I don't have to be near anything. So I pay like $200-300 a month for my little closet. And that to me is super important because I think that that is very, very important to function. Now, what about a net lease? What is a net lease? Okay. Net lease is when the tenant pays. So some people are saying triple net lease. Yeah. Here's the thing. They might refer to it as triple net or they might refer to it as net. Personally, I think that the test writer will probably refer to it as net listing. A net lease, excuse me. So a net lease is basically when tenant will pay flat fee plus all expenses. Now, just for the heck of it, for, you know, poo-poo and giggles, I just want to ask you this question, okay? Why would someone want to do that? Why would a tenant want to do it? And when is that most common? Okay, like what types of properties is that most common in? Commercial properties. Yeah, this is super big in commercial properties. A store in a mall would probably be more percentage lease. This would probably be more like your Sports Authority, Best Buy. And let me tell you why they want to do this. You ready? So if you're working for like a Best Buy and you're their real estate professional, and you say to them, hey, I know you want to open up a new store in, let's say, Jersey City, New Jersey, but it's kind of expensive, the commercial space. And Best Buy's like, yeah, we know, and we can't really afford to buy it. And they go, well, we'll rent something. But then Best Buy goes, yeah, but we want to get all the benefits of ownership, all those wonderful, beautiful tax write-offs. So here's what happens. Best Buy will sit there and say, hey, Mr. Landlord, we want to pay all your expenses so that we could write them off, but we don't want to own the building because that's way too expensive. We want you to take that risk. We're going to take care of all the expenses so that, excuse me, we could write them off. Does that make sense? Now, does that like make sense in your head why someone would want to do that? Because people always ask me, they're always like, why would someone want to do that? I'm like, it's the benefit of ownership without owning it. I'm like, it's awesome. Will said, yes, I always wondered. Well, let me be the key to unlocking the wonders of your mind and putting you at ease in knowing the reasons why. Because here's the thing. Do I think that's super important for you to pass your test? No, but I think that in order for things to stick inside the brain a little bit sometimes you need a little glue that is a good story and a good understanding of it that helps you get a great grasp on what the story is, what's going on with that, you know? So that is a gross lease, net lease, okay? So, I'm something else. I really am. Well, you know what? I try to give you the best explanations. This is what I do. Listen, literally, this is my full-time job, is sitting here doing my YouTube videos, doing classes like this for you guys. So that's why I appreciate you guys sharing, you guys liking, you guys saying, hey, this is awesome stuff, because this is what makes the bloodline goes through. So this is really, you guys supporting this has been why I'm still here doing this. So I want to thank you for that. Now let me give you guys the liens. And that's where I think we'll end today, is talking about our liens. You ready? So here's what the story is with liens. They're either going to be specific or general, and they're either going to be voluntary or involuntary. So a lien is a financial claim to a property. It is one type of encumbrance, okay? The other types of encumbrances will be that of physical encumbrances, usage rights, things like that, okay? So if it is a specific lien, it is going to be a on one particular property, Okay, so the real estate taxes for that home, specific. And involuntary, no one volunteers for taxes. Okay, no one goes, I'm going to take that as my best option right now. I would love to pay taxes. No, that's not the case there. So specific, involuntary, right? Specific, yeah, one property. It's on that specific property. The mortgage lien for that property, that would be another one that is specific but voluntary, okay? So a lien is basically a financial claim to a property. It's basically saying, hey, if that property sells, if it's transferred, or I have an interest in it, that means that if you, if you decide to sell that property, or if someone else forecloses on that, I get to be paid back in the order in which I took priority. And that goes according to how it's recorded, except for the general real estate taxes or ad valorem taxes. Those are the same, Yeah, lien is money owed, lien money, okay? So what happens is this, the order and priority in which they're going to be paid off goes by when they are recorded, except for ad valorem or general real estate taxes. Those will always be first priority. So a judgment or income tax lien would be a general lien, because it would go on all of the property you owned, even maybe your personal property, like if you owned a Lamborghini, business, things like that. So general liens go against everything you own, okay? Yeah, the most dangerous, a judgment. So that is liens in a real nice, easy to swallow nutshell. Okay, Dreda, you're awesome. Okay, so let me do this. Let's cross off liens. So here's what I'm going to say. That's going to bring us to the time that I'm actually going to stop recording this. So this is where the recording will end. So I'm going to stop it.